By my reckoning, it's now 11 o'clock, so time to get going on our first show of the year. Andrew McHattie has joined me here. We're going to talk about what happened over 2021, just looking at the investment companies sector by sector. As we go through, we've just basically done is rank them by NAV performance over a year. So we're going to take it in turns. I'm going to hand over to Andrew to get going. Best thing we do, as we did last year, I think, is if you've got questions, can you just sort of put them into the Q&A function as we go along, or you can obviously email me if you just too. That just means we'll just sort of keep the thing flowing rather than try and leave everything to the end. So without further ado, over to you, Andrew.
Okay, wonderful. Thank you very much, James, and good morning, everybody. We'll see if we can get this done in an hour this time, James. So we'll rush through it. A quick overview to begin. Although 2021 was a very difficult year in many respects for everybody, it wasn't a bad year for global equities. In fact, it was really very good. The blue line at the top here is a FTSE All World Index, which was up. It depends exactly when you take the data, of course, but it was up about 17%. And the black line is the closed-end universe, which was up about 10% or so, which is in a way is disappointing, but actually it kept pace with the green line, which is the FTSE 100. And effectively, we were just giving back, I think, the extra performance that was gained in 2020. So not bad. It was a mixed year. And as we'll see, some sectors did very well and others not so much. But it's great to get a perspective on it all, I think. So let's move on and look at the global trusts, which did do very well, actually, somewhere between 15 and 20%, depending on the data. All of my tables are from yesterday. I think what's evident here, we've got the usual mix of performance, but for me, I think the outstanding trend is the rotation from growth to value, which I think is evident here. You can see Scottish Mortgage is fairly near the bottom of the list here. It was a bit higher a few days ago, actually. Its performance was actually quite good in the first half of the year. And then actually, in particular, in the last couple of months, we have seen a bit of a sell-off as investors have become more focused on the prospects for higher inflation and interest rates. And I think that means they've been a bit less keen on the long duration returns from growth stocks, and Scottish Mortgage has settled back quite a lot. So near the top, we have Brunner and AVI Global. And whilst I find managers really don't like the value tag, I think they are both more value-oriented managers, and it'll be interesting to see how that plays out this year. Towards the bottom of the list, there were three that stood out for me. Keystone Positive Change, where the new managers have been in place since February last year. So far, they haven't had the positive impact they were hoping for. So the clock is probably ticking a little bit for them. They'll be keen to move up the table if they can. EP Global Opportunities had another quite disappointing year. Not the first. I've highlighted that a couple of years in a row. So again, there might be some pressure on that trust to improve, I think. And then the last one that I think caught my eye near the bottom was Linsell Train, where Nick Train, of course, is a very forthright character and has addressed this head on. And he said that last year was perhaps the trust's worst relative performance in its 20-year history. I mean, actually, it wasn't terrible, but the problem for shareholders was that it was such a highly rated trust that, of course, the derating meant in share price terms, it was quite poor. And actually, you'll see, if you look very carefully here, that it was down 6.6% in share price terms over the year. So we'll see how that gets on next year. So we'll move on now to the global equity income. I don't think I have very much incisive to say about this. Pretty good returns overall, quite similar to the broader global sector. And actually, I found here that the trusts that we already thought were good, strong performers maintained that performance last year. So JP Morgan Global Growth and Income had another good year, and so did Scottish American, which I think is broadly considered one of the better trusts in the sector. The Invesco Select Trust also had a very good year. Down at the bottom, right at the bottom, McHattie Investments really was quite a laggard here. And I think it must have been quite disappointing for shareholders when the management company was taken over by Lion Trust towards the end of the year. And unfortunately, I mean, that quite often would herald an upturn for the trust because it had quite a big holding in the manager, but actually it was already in the books at a slightly higher price. So actually shareholders took a small hit on that. So I think that probably dashed a few hopes of a good uplift. So that was a shame. Also next to bottom, Murray International. I get quite a lot of questions about Murray International from clients who are invested in it. It's a popular trust. And it does go through periods of underperformance. I mean, it has done throughout its life, and then it will recapture the gains actually during different cyclical moments. So it does have a fairly defensive strategy, and Bruce Stout is quite well known for that. So whilst it is behind the leaders now, I wouldn't bet against it moving up next year. So we'll see. Global smaller companies next.
I'll just interject quickly. There's a question here. Any thoughts on Hint?
Yeah, Hint, I think, I mean, it was pretty much in the middle of the pack last year. I think Hint is actually quite a well-managed conservative trust. I think it just returns, quite well over, and is quite, a sensible trust, actually. I'd be happy to own that as a kind of cornerstone equity investment. It's probably never going to shine too much and be at the top of the table, but I don't think it will let you down either.
And one more. Bruce Stout has obviously been manager of Murray International for many, many years. If he does step down, do you think it's going to make a difference to the way it's run?
Yes, I think it might actually, because I mean, very often, the board are focused on continuity, but I think Bruce has a very particular style of management, and I'm not sure that would be replicated by another manager. So, of course, it's quite possible that shareholders who would be consulted would ask for a similarly, defensive, contrarian approach, and so the board might be able to find another manager that can do that. But equally, there could be a shift.
Yep, cool. Right, moving on.
Yeah, global smaller companies. Again, a pretty decent returns overall here, with one outstanding exception. Edinburgh Worldwide had an absolutely terrible year, which in a way is quite surprising. I mean, it's a little bit hard to explain why it's done so badly. Some of its previous winners basically gave up their gains. The manager has also blamed some of the holdings in Chinese stocks, but these don't make up a very big proportion of the total, actually only 4% at the end of November. So I think it's a bit worrying, particularly as the trust is still on a premium rating, still on 2% premium when I looked. And so I think if it doesn't raise its game quite a bit in the fairly short term, there's a risk of a derating there. That said, I think you do have to cut the managers a bit of slack. I mean, this is their first underperformance in 5 years, and perhaps it was just inevitable there'd be something of a downturn after such a great run before. But I think that's definitely one to keep an eye on. And on the upside, North Atlantic smaller companies, sorry, I called it North American there. North Atlantic smaller companies managed by Chris Mills was the top performer in the sector over the year. It's also on the widest discount of 23%. But before you think, well, hey, that's a great opportunity, I'll just point out that it does always tend to trade on a wider than average discount. That's the nature of the structure of the trust, I think, and the large managers holding. But it certainly did well last year. we can't say the same about global emerging markets, which really were flat over the year. They weren't the place to be at all. I think that's partly because they're probably a little bit behind the cycle when it comes to COVID, and because there wasn't a tremendous risk appetite either. And in a world where growth is scarce, if growth is not really coming through, then people will avoid it. So it wasn't a great place to be. But again, I think there's just one trust that really stands out here, this time for an exceptional performance, a good performance, and that was Mobius Investment Trust, managed by Carlos Hardenberg, with Dr. Mark Mobius in the wings, lending his experience. It does have a very different approach, and it's very focused on ESG. And I think, unlike some trusts which maybe do pay a little bit of lip service to this, this really is completely central to the way they work. And their whole approach is based on choosing good companies that have an opportunity to improve their market rating by improving their ESG. So they focus on things like improving the quality of the board, making it more independent, more diverse, improving transparency and management remuneration, publishing sustainability reports, etc. And it seems to have worked really, really well. It is still a young trust. It doesn't have a 5-year record yet, but the initial indications are that they're really onto something. I think they got ahead of the ESG curve, and it's really paying off.
One of the funds that's sort of disappointed for a while is the Fundsmith Emerging Equities. What do you think about that one?
I've never really liked it myself, but I think Fundsmith have a very high reputation as managers, but this one, that it hasn't really achieved what they set out to achieve, and it disappointed. So they changed the manager, and it's never really picked up. But it's always been on quite a high rating, and for me, it's hard to see why you would choose it. I mean, when there are actually some very decent, consistent performers here, such as the JP Morgan Emerging Markets Trust, which has a good long track record that's been very good. There are clearly people who are just fans of Fundsmith, would like it, but it's not.
Doesn't seem to work in emerging markets so well. No,
I don't think it does.
Somebody's actually pointed out here, it is quite weird, given that the managers of Mobius used to run Templeton, that they're at opposite ends of the table.
Yes and no. I think, I get that argument, but I think actually Mobius is run with a very different style. And it's this focus on ESG, which is really something very distinct and different. And that was new when they launched the Mobius Investment Trust. Okay, thanks.
Right, which brings it on to Flexible, which is me. So this is a mixed bag of a sector. So funds are doing very different things. But we've got sort of all positive returns, which is good, because that's the main thing that they're all trying to do is produce absolute returns. So in terms of that point of view, they've ticked all the boxes. The winner here is Caledonia, and that's really coming from its private equity investments. So it's had a couple of big realizations during the year, Deep Sea Electronics and Bioagilitics, and they both added quite a chunk to their NAV. The next one down is the Fund of Funds, used to be called Might and now Migo Opportunities, run by Nick Greenwood. And he's done very well this year, just picking good funds that have done quite well. And that's obviously been working out. The other one I wanted to highlight on the upside is Rick Capital. It's one of the ones that is trying to produce relatively low volatility, positive returns. And it does it by investing in a wide range of stuff, from hedge funds and credit to betting on currencies and all sorts of things. Quite different to almost any other fund that's in the sector, and maybe slightly more akin to some of the hedge funds. But it does have private exposure as well, and so it's a real mix of things. And they've just been doing very well, and that discount has come rattling in, as you can see, the difference there in the share price returns. At the other end of the table, We've got the Schroder BSC Social Impact Trust, which is obviously relatively new. I think that is not trying to smash the lights out every year. That's not what it's about. It's mainly trying to produce positive social impacts. So whether that's trying to keep people out of care or increase the amount of social housing, that sort of stuff. And the returns should be positive, but aren't never going to be particularly spectacular. That's not really what it's about. JP Morgan Global Core Real Assets is a similar sort of thing. It's supposed to be kind of a steady Eddie thing. But in markets that have soared, these things sort of get left behind and look a bit dull. What we'd like to see is that if we have a weaker year in 2022, that these things will still be producing positive returns. So we'll have to wait and see whether that's true or not. There's a question about Momentum Multi-Asset, which used to be the Seneca Fund. And their value focus of that has really come through this year. And it's also quite a lot in equities for a fund that's invested across a number of different assets. So that's helping too. Okay. UK All Cap. One thing that I did notice is that there was a bit of sort of discount widening going on in the UK. So when we were coming into 2021, there was a feeling that with Brexit out of the way and the vaccines reducing the need for lockdowns, that UK's might now have a time to shine. And it worked for a bit, and then it sort of petered out a bit. The main sort of influence is becoming really whether you're invested in value or growth type of stocks. And most of these things were sort of lead towards the growth end of things. But special situations, which Alex Wright does with Fidelity Special Values, did relatively well. He's quite positive in the outlook for 2022, and he's thinking that UK stocks are quite cheap relative to national peers, and that means that there could be quite a lot of taker activity going on. But he is a bit worried about the impact of inflation. I think that's a thing that's going to be quite commented upon as we go through the year. At the other end of the table, Artemis Alpha, it really comes down to stock selection. Almost everything they touched seemed to go wrong. So they ended up with investments in things like Ryanair, Delivery Hero, and Just Eat, all of which fell back during the year, and some house builders too. It's also got some overseas investments, and none of them seem to have worked either. So it had a good year last year, but actually its performance hasn't been great for a while, and I just do start to think whether shareholders might get a bit restless there. We'll have to wait and see. Let's do that. I'm just going back to, so I don't want to keep jumping back because as many of us get through this, but a couple of questions. Going back to this one again. There is a difference between JP Morgan Multi-Asset and JP Morgan Global Core Assets. So Multi-Asset has got much more equity exposure, and that's the reason that it outperformed JARA. And a lot of these things have reinvented themselves. So one of the questions is, has Aberdeen Diversified and Growth turned a corner? I think it's too early to tell, really. With all of these things, you're going to need sort of 3 years worth of data to see if what the shake-ups that they've put in place last year are actually flowing through into returns. You can't remeasure that on a short-term time frame. And then going back to UK again, and Fidelity Special Values. Yes, Alex is still big on banks and financials, and we haven't got actually a slide on Polycap Financials here, but they had a good year in 2021, and we think that's going to carry on going. It's a value sector. It's being helped by the fact that actually not as many things have went bust in the wake of COVID as people maybe thought were going to happen. And actually returns are picking up for banks, and higher interest rates would make a big difference to their margins. So that would be quite good news. Now, this one, although I couldn't quite fit the title on the page, is the income, UK equity income. And here, the big three, Chelverton, British American, Merchants Trust, they're all very heavily geared funds. British American particularly so. and that one is particularly volatile. So the gearing obviously increases the volatility of the returns of these things. It's means that sort of makes them look maybe better than they would be otherwise. I think I'd want to highlight Temple Bar because it's obviously the poster child for value investing, and it's done particularly well last year, even though the value rally seemed to peter out as we came through into the second half of the year. And I'm thinking, because we've seen some weakness in growth recently, that if people do decide that Omicron isn't as bad as was feared, that we could see another sort of second wave of this value rally. So we'll have to wait and see whether that plays out or not. At the other end of the table, you've got the other Nick Train Fund, Principal Growth and Income, which Andrew's already discussed with the Insel Train, where the focus on sort of defensive quality isn't really working. And that's also evident in BMO UK High Income, but that's very much what that portfolio is about too. So sort of big defensive income stocks like tobacco and sort of consumer goods sectors as well. And then small cap. And I wrote small cap beat large cap in 2021. That does depend on which index you look at. So I've got, we should notice, sorry, we're rattling through this, maybe with you explained. Here in the corner, we've got the index performance. So the MSCI, unless they're otherwise stated. So newest small cap plus AIM was up 20%. So you can see that most of these companies outperformed that, which is obviously a great result for the investment company sector. The real big winner on here is actually quite tiny. It's Chelverton Growth Fund. It's less than 3 million quid. So I don't think it's probably worth paying much attention to. It's also got 60% in one stock, which is not the sort of thing we normally recommend. Rights and issues, which is a bit sort of publicity shy. It's quite hard to find out information on them. They're not very good at publishing fact sheets and things. I think that the main winners there in their portfolio would be McFarlane and Reynolds. So it's just a question of stock selection, but they do have a lot of holdings in common with things like having UK smaller companies and BlackRock Throckmorton. So I think that's obviously why those things are winning, and that's again quality growth rather than quality defensive that's kind of worked there. At the other end, Worsley again is another little tiny fund and quite peculiar. It's got a big holding in Italian cinema, but it is noticeable that the micro cap generally didn't do very well. So even though Chelverton bucked that trend, Downing and Mighton and even River and Mercantile were down towards the bottom end of the table. And now back to Andrew.
Yeah, Asia Pacific next. This is broken into some smaller categories, so it doesn't look like a very big sector here. Pacific Horizon is the obvious medium-term winner in this sector, the Baillie Gifford managed trust, trading on a premium that has actually shrunk a bit over the year, but is still 9%. It was beaten into second place here by Pacific Assets, which is on a discount. And again, I think that might speak somewhat to the nascent rotation a little bit out of growth, but we'll see. It's going to be interesting to see how Pacific Horizon does, because it really has been the outstanding trust by a wide margin for the last few years. I think if you are looking for other trusts in the sector as alternatives, if you believe that that actually the premium is going to disappear on Pacific Horizon, and I don't know whether it will or not. I think it's that the wide margin of outperformance over a long period might mean that actually it stays on a premium for a while, but we'll see. If you're looking for something else, I've been quite impressed actually by Schroeder Asian Total Return by Robin Parbrook, and I think that there's an argument for that trust as a medium-term performer as well. Down at the bottom, you've got Asia Dragon Trust, which is definitely more value-oriented, and that hasn't been helpful. That I think really needs to pick up a little bit. We'll see whether it does once this rotation kicks into place, if that is indeed what happens. So yeah, nothing else to say on that. We'll move on to income and smaller companies. Asia Pacific income is a funny sector for me because I can see the appeal of it, that actually you want to keep your toe dipped in the waters where there's a lot of economic growth going on, but you'd also like to get some income from it. And so it's quite tempting, actually, I think, to have a look at this sector. And I have had a holding in it myself occasionally in the past, but it's always tended to disappoint. And I'm just not sure that income mandates play out very well in this region. The returns weren't terribly good last year. The pick of the bunch was Aberdeen Asian Income Fund, which is also on the widest discount. So that one is perhaps one to consider if you really want to go down this road. But I'm not convinced. Smaller companies have done much better, and that's not just over the last year where they have, but previously as well. And this is a sector where, for many, many years, actually, Aberdeen Standard Asia Focus and Scottish Oriental smaller companies have been like twins. They basically performed in a very similar fashion, both done quite well, actually. And I thought it was a little bit odd that they noticed quite a big, there's quite a big difference last year, a divergence in performance. And the Aberdeen Trust actually did much, much better than Scottish Oriental smaller companies. The return was 22.7% against 14. And in fact, it was a little bit wider a few days ago as well. And yet they're basically on the same kind of discount rating, both at just over 10%. So perhaps there's a switching opportunity there if you believe those trends will continue. I'll move on from that. Of course, here we spend a great deal of time talking to individual managers and digging into the minutiae, which is very enjoyable, of all of the investment trusts. But actually, sometimes you just have to make big calls on the macro and on countries. And if you're comparing China and India over the last year, that was what you had to do. You had to avoid China and be in India. A terrible fall in China, actually. It was the worst performer of the lot in terms of the sectors, whilst India actually did really very well. I have found over many years that picking single country investment trusts is a little bit of a lottery. The returns are inconsistent, and I think you have to maybe accept some of the ups and downs and ride them out if you're a long-term investor. But certainly it was a terrible year for China. None of the funds did well. The Aberdeen China one at the top there, which really looks as though it outperformed the others by a wide margin, actually wasn't the China fund for the whole year. That was the old emerging companies fund. So anyway, there's no particular benefit there. Turning to India, I think what's interesting is that the two large older funds here, JP Morgan Indian and Aberdeen New India, were slightly behind actually the more exciting funds that maybe are focused on smaller companies. And at the top, there's a trust that maybe isn't very well known because it's still quite young, and that's Ashoka India Equity, which has outperformed very considerably. And it's quite an interesting trust. It has quite a few odd features. It's an all-cap fund managed by a former Goldman Sachs chief investment officer. And he set up the management company, which doesn't have an annual management fee. It's just performance fee only, paid in shares. And it really has done fantastically well. It is on a premium rating, but that is supported by an annual redemption facility that hasn't really been used because, of course, it's been very attractive and it's been growing. Actually, it's managed to issue quite a lot of equity over the last couple of years. It doesn't employ any gearing, so that's not why it's outperformed. It's all been down to the stock picking. So if you haven't looked at that yet, I think it's worth checking out.
Would you like to venture a choice for 2022 between China and India?
I was desperately trying to avoid that one, actually, James. Well, I think I do tend to think there's a bit of a seesaw effect, and actually, all of the macro comment I read at the moment is very dismissive of China and says you really ought to avoid it because it's got a lot of challenges to its growth profile in the year ahead. But historically, actually, if you bought the worst performer of last year, you tended to do better than if you pick, if you think the trend's going to continue. So I don't know. I honestly, it's very difficult, I think, to choose.
Yeah, there's a question here about capital growth. I mean, that's just got through a retention opportunity. So people were given the chance to cash in their shares if they wanted to, close to asset value. And actually only 13% of the company did. I think that just speaks to the sort of faith that people have in India at the moment. The manager's saying, yes, parts of the market are looking expensive. It's really going to come down to stock picking now. Whereas the managers of the Chinese funds are saying that their stocks are looking quite attractively valued. But that's all relative to history, and it does depend a lot on what happens with earnings. So we'll have to wait and see.
Yeah.
I just thought while we're on this sort of topic, we should have a quick look at Vietnam because there's these three of these funds. And the clear winner there was Vietnam Holding, but overall, all three of them did amazingly well. And that just reflects the growth of the export markets within Vietnam. That it's taking a huge chunk of the business that China used to do. It's become a sort of manufacturing alternative. And it's gone from doing quite sort of basic things, the sort of textiles and stuff, to quite complicated truck stuff. So it's making components for iPhones and all sorts of things, and Samsung phones and things like that. And the whole economy looks great, really, if you look at it from a distance. The real kicker, though, for this year could be that it finally gets upgraded to emerging market status. When we've seen that happen with other markets, you get a big rush of capital as all of the index tracking funds rush to invest. So we could get another leg up. I think it may not happen this year, but it may look like it's going to happen in 2023. So I think it's going to be sort of something towards the end of the year. Vietnam Holding, we should also mention, it's got a big focus on sustainability, which is the same thing that you picked out from Mobius. I do think that is going to be sort of quite important with the emerging markets going forward. Back to you.
All right, so more established markets now. North America and Latin America. North America, where the investment trust industry has always been thoroughly underrepresented, actually had another cracking year, of course. This really was a good place to be. And I think this goes part way to explain why the closed-end sector underperformed the FTSE All-World Index last year because of the North American component. So it was a good place to be. Not so great, though, if you were in the big winner of 2020, which was Bailey Gifford US Growth, where it found its growth stocks were out of favor last year, and it's actually lost a little bit of money over the year, which is perhaps quite surprising given the strong returns elsewhere and the average return of 27%. I think I would possibly select here the trust that came second over the year, JP Morgan American, which I've written about many times over the years. And I think a little bit like a hint, which I talked about earlier, I think it's just a good, solid, reliable performer. Probably won't be top of the table, but I quite like it. And I think actually, if you want a nice cornerstone investment in the world's largest equity market, then JAM, as it's known, is possibly one to have. I see Canadian General has been mentioned in the questions. Had a reasonable year last year. I really like this trust, actually, and it's not for everybody because it has a majority family holding, and so there are corporate governance issues. And the fact that it's on a massive discount of more than 30% is not really relevant because it's always on a massive discount over 30%. The only thing that happens here, which was pointed out to me by Jonathan Morgan, the manager, when I talked to him, is that every now and again, the trust does get picked up by someone in the media in the UK who writes a glowing article about it and its massive discount, which the Telegraph did actually a little while ago, and the discount closes in for a while, and then it just slowly creeps back out again, back to its normal position. But it's a very good trust, I think, very well managed, good returns, and they are quite focused on not losing their family money, so I think that helps. Latin America was a bit of a disaster zone. Again, I think it's just behind in the COVID cycle. All of the comments about emerging markets applied here, that nobody really wanted them. And Aberdeen Latin American income was particularly bad. BlackRock Latin American, clearly also, terrible underperformer. And because of that, it has announced a tender offer where I think they'll probably see quite a lot of shares come back, but it's not going to happen for a while because they have to have their vote and everything. Historically, actually, this hasn't been a bad time to buy. When these trusts are absolutely despised by everybody and have performed terribly, they can actually have great runs. So I wouldn't dismiss them entirely. If you're a contrarian investor and prepared to take the risk, then I wouldn't rule them out.
One more question there about brand advisory.
Sorry, yes.
I think it's a bit early to tell with that one, actually, because these are people that took over from Jupiter.
Yeah, I'd agree. I don't really have a strong opinion on that one yet. Sorry,
Europe.
It's not helpful.
Yeah. Europe, again, people keep sort of writing off Europe, but the performance of the market was relatively strong, and particularly if you were in high quality growth stocks, which is the same sort of pattern that we talked about in the UK as well. And here the two leading funds in that area, Montanaro and BlackRock Greater Europe. So Montanaro, I mixed up the small cap and the large cap funds. So Montanaro is obviously a small cap fund, and the BlackRock is a sort of an all cap investment trust. And those returns have been pretty good for quite a while now. And you can actually see sort of 30% a year over 3 years. We are talking about some serious money now. At the other end of the table, we've got the growth focused funds like Betty Gifford European Growth, which is, again, so these funds are sort of popping up towards the bottom of most of these tables now, as they give back most of the good returns that they got last year. I think maybe it could be that people are worrying about rate rises, and that makes growth companies look less attractive over the long term. And so that could be a thing that persists. Henderson Euro Trust, it does really come down to stock picking, I think, because they said they didn't perform very well because they weren't in the cyclical companies, but the things that they did hold also got hit by COVID. So yeah, that's the reason why it's sort of lagged this year. We'll be looking for that to improve, I think, because we don't want that to sort of lag for too long, otherwise people are going to get a bit antsy about it. And you can see that the share price was a long way behind the NAV, so that the discount is widening. There's a question about whether these funds have a particularly strong ESG focus. Again, the one that really shines on this is the Montanaro fund. It's something that they've embedded with their investment process for a very long time, and it's they've written quite a lot about it. And if you want to know more about it, I'd suggest you go and look at their website or read one of our notes. But yeah, that's definitely a ESG star in that group. Japan, it's a very mixed year, as you can see there. We've got small cap underperforming large cap, and growth profit taking again. So sort of there's not really much of value going on there. If you want to sort of look at value, I suppose it's the corporate governance funds. And they're performing not so much because value has come back into favour, but much more because they're actually getting some really decent results in terms of targeting companies and getting them to do things like buy back their stock, or actually they've engineered quite a few takeovers, and that's feeding through into the NAV. And because of the ridiculous valuations that they're buying companies at, there is quite a lot more potential for them to carry on doing that, even if markets aren't quite so hot. So we'll have to wait and see what happens for 2022, but I'd still stick with those. Going back to the sort of value versus growth fund, there's definitely CC Japan is much more of a value type investor because of its income focus, and that probably gives you an indication of what's going on there between the value versus growth. Is there much overlap in the companies that AJOT? No, actually, I think there isn't a huge amount of overlap. There's just such a big pool of stocks that are trading at a discount to even cash in some cases that they don't have to go over after the same ones. So there is a little bit of overlap, but the actual portfolios are still quite different.